Welcome to the National Insurance Academy, Pune. National Insurance Academy is a premier institution devoted to equip the insurance industry with the best of talents and expertise. The sprawling academy campus, with its lush greenery, provides the ideal environment to the insurance practitioners for involved learning. The Academy also conducts a 2-year postgraduate diploma in management course. This course provides an ideal blend of expertise in management and insurance. The Academy is also focused on research and development activities related to the field of insurance. This online series on basics of insurance will help you understand the fundamentals of insurance. The first lecture in this series would teach you what insurance is and how it works. Welcome and happy learning.
Welcome to the course on the basics of insurance. In this session, we would be talking about what insurance is and how insurance works. What is insurance? It is basically a loss-sharing mechanism. Even informally, it has been operating. We could think of a group where one of the members of the group, the breadwinner, died and his family is left with nothing to fend for itself. At such times, the group voluntarily contributes and gives some kind of relief to the unfortunate family. But this is a temporary arrangement. This is voluntary. This could be inadequate and this might not be reliable as a form of loss mitigation. We need more formal mechanism which assures ourselves that in the event of a misfortune striking us, there is some reprieve available, there is some compensation available. So what could be a kind of a formal mechanism which ensures that a person who suffers a loss is compensated? Insurance is one such formal mechanism. In insurance, the insurer collects a group of people who are exposed to the same probability of loss arising out of a particular peril, particular danger, and he collects money from each of such people who are exposed to that danger. He develops a corpus from such collections, and whenever somebody has a loss, the loss should arise out of the danger to which he was exposed to. Whenever a person suffers a loss, then money from the corpus is taken out to compensate the loss suffered by the gentleman. Now, you might wonder, how does the insurer know how much to collect from each? Because the insurer is collecting the money upfront and he is promising to pay every person who suffers a loss arising out of a particular danger for which he is insured. The numbers could go totally wild from what the insurer could have anticipated. So he cannot later go back and ask the group members to contribute more. That is simply impossible. Once the insurer promises to pay money in case an event happens, he has to pay. Otherwise, he will lose credibility. So how does he decide? How does he know how much to collect from each person? He knows this because he knows the law of large numbers. What is the law of large numbers? The law of large numbers states, as the number of trials of a random process increases, the percentage difference between the expected and actual values goes to 0. Does it look difficult? Don't worry. We will get to understand the laws. Let us take a simple example of tossing a coin. Tossing a coin is a random process. It has only two outcomes, either a head or a tail. Therefore, the probability of getting a head when we turn a coin once is 1/2. All of us are familiar with this probability. We all know that getting a head out of a toss of a coin has a probability of 1/2. Therefore, in this case, the expected outcome is 1/2. Now let us toss a coin twice. If we toss a coin twice, does it mean that we should get one head and one tail? Possibly, but it is also possible that we may get two heads and no tail, or two tails and no head. Getting two tails when you toss a coin twice is quite likely. If such an event happens, the actual outcome of getting a head is 0, whereas the expected outcome should have been 1/2 of 2, at least one head. Therefore, there is a significant difference between the actual outcome and the expected outcome. Because the number of trials is only 2. But let us see what happens when we keep increasing the number of trials. Let us toss a coin 10 times. It's quite possible that we could get 6 heads and 4 tails, or 4 heads and 6 tails. Now you could ask me, is it not possible that I could get 9 heads and 1 tail? There is a possibility, of course, but it is quite unlikely. Similarly, getting 9 tails and 1 head is also unlikely, though not impossible, in a trial of 10 tosses. Let us assume that we get 4 heads. So, out of 10 trials, we got 4. Whereas as per the expected outcome of probability 1/2, we should have got 5. So the actual outcome is 40%, the expected outcome is 50%, the difference is 10%. Now, let us increase the number of trials to 100. Let us toss a coin 100 times. You may get 45 heads. You toss it 1,000 times. You may get 470 heads. Toss it 10,000 times, you may get 4,800 heads. Toss it 100,000 times, you may get 49,000 heads. Toss it 1,000,000 times, you may get 4,95,000 times heads. And toss it 1 crore times, you may get 49,75,000 times. This is an example, but the actual outcome could be that you get more heads than tails or more tails than heads. But as the number goes higher, 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 and higher, the difference between the actual outcome and the expected outcome keeps coming down, down, and down. This essentially is the law of large numbers. Jacob Bernoulli, the Swiss mathematician, framed this law in the year 1713, 300 years back, and yet it works. So now, when you look at the law, I think it would make sense. The number of trials random process. Random process is tossing a coin. Number of trials keeps increasing from 10 to 100 to 1,000 and so on until a crore. And the percentage difference also keeps coming down as we had demonstrated. The difference was 10% when the number of trials was 10, and it came down to 0.25% when the number of trials is a crore. So this is how the law of large numbers is also used in insurance. But there is a fundamental difference. In tossing a coin, you know even before tossing it what the probability of outcome is. But when you want to provide a particular cover, let us say we want to cover theft for vehicles. So what do? You study past data. You see how many vehicles have been stolen. To make such study and to make such prediction, we have experts who are called actuaries. Actuaries are professionals who are experts at studying vast amounts of data and also estimating what would be the future probability of losses arising out of a peril. They study past data and they also adjust for trends that happen. For instance, there could be a trend that people aged between 45 and 55 could get more numbers of hospitalization. It's a possibility. Therefore, they look at the trend, and if based on the past data and the present experience, there is a change, they adjust it. As the data studied is larger and larger, and as the past history is longer and longer, there is a higher likelihood of the actuaries' predictions matching the real experience. Now, this is important. Actuaries make a prediction that, yes, you cover 100,000 cars, the number of vehicles stolen could be 400. But to make it work, you need to cover more numbers. As discussed, actuaries study past data, adjust for present and future trends, and estimate the probability. But the estimate will work only when more and more of such risks are covered. As the size of the insured group becomes larger and larger, the accuracy of the actuaries' predictions become better and better. So we saw what law of large numbers is about. That law helps us to determine in advance on how many losses could happen in a given group. If an insurer insures 10,000 cars, with the help of law of large numbers, he will know how many cars would be stolen. If an insurer insures 10,000 people for death arising out of an accident, he will know how many are likely to die out of an accident. It is at best an estimate. Please understand that with large amount of data, the actual outcome would be likely to be closer to the expected outcome, but there could be exceptions. But an insurer, as he collects a larger and larger pool, and as he analyzes a longer and longer history of past experiences, becomes quite efficient at determining what the loss ratios would be. Therefore, with the help of law of large numbers, we can say that what is uncertain for an individual is certain for a group. Please remember No insurer can tell me whether my car will be stolen or not. No insurer can tell whether Mr. A will die out of an accident or not. But for a group, an insurance company is in a position to tell us. And please remember, an insurance company groups people according to their exposure. The probability of a 25-year-old person getting hospitalized for a sickness and the probability of a 60-year-old person getting hospitalized for sickness will be totally different. Therefore, they collect groups according to the exposure, according to the probability of loss. What could be the probability of number of accidents in 10,000 trucks? It could be quite higher than the number of accidents for 10,000 cars. Even within cars in certain cities could be rated higher. In fact, in some countries, cars are rated depending on their color too. Therefore, depending on the characteristics of the exposure, the risk characteristics, the rating is done. But once the rating is done, and if the loss arises, the insurance company pays. But the loss should arise out of the particular peril for which they have insured. This is one area where there could be quite a bit of misunderstanding. If I have insured myself against death by accident, if I die due to an accident, the insurance company will pay. But if I die due to natural causes, the insurance company will deny the claim. Please understand, the number of deaths arising out of natural causes and accidents could be much more than the number of deaths by accident. A general insurance company usually covers death only against accident. So the data that they have analyzed is on the accidental death, and the loss that they are covering is only for accidental death. Therefore, the conditions under which the claim would be paid are very clearly laid out in the contract, which is the policy. So there are limits on what would be paid. There are limitations on the conditions upon which the amount would be paid. So these have to be read carefully. An insurance company works on the principle of sharing the losses of a few among entire group of people exposed to the same kind of loss. Therefore, the mechanism, if it were to work correctly, should have clearly laid down terms and conditions. This is what the insurance policy does. We have learned what insurance is and how it works. Now let us also discuss the formal definition of insurance. Insurance, strangely, has not been defined under the Insurance Act. But over the years, a formal definition has emerged. Insurance is an agreement whereby the insurer, for a consideration called premium, agrees to make good the loss suffered by the insured arising out of an insured peril. This is a formal definition. I will explain to you each and every element of this definition, because each and every element has a significance, as you would understand.
So what is insurance? Insurance is an agreement. An agreement has two parties. In the insurance contract, the parties are the insurer, who is an entity permitted by the regulatory authority to transact insurance business. The other party is the insured, who is also called the policyholder or the customer. So the insurer and the insured come to an agreement. and this agreement is enforceable by law. It's a contract, and all contracts should have a consideration. In the insurance contract, the consideration for the insurer is the premium. The consideration for the insured person is the promise the insurer makes. Now, what is the promise that the insurer is making? He promises to make good the loss. Now, what is this expression, make good the loss? In a later session, we will study the intricacies relating to this phrase, make good the loss. It flows from the principle of indemnity. For the present, please note, making good the loss means compensating the financial loss. And the loss should have been suffered by the insured. This is important. For example, if Priya had insured her car and her father's car was stolen, Priya's insurer will not pay. Why? Because Priya has not suffered the loss. This flows from the principle of insurable interest, which is also something we could be studying at a later session. And the last phrase, arising out of an insured peril, is very important. Please remember, an insurer does not agree to pay to compensate for a loss, no matter how it was caused. He agrees to pay for a loss which was caused by an insured peril. Please recall the example I had mentioned during this lecture. If a person has taken a personal accident policy and that person, if he dies due to an illness, the personal accident insurer will not pay. Why? Because the insured peril is accident and not illness. So, in order to be eligible to make a claim, the loss should have arisen out of an insured peril. So, this in essence is what insurance is about.
So in this brief session, we have discussed what insurance is and how it works. We will have a quiz. The quiz form would be available at our website. If you are interested, you can take it and find out how good your understanding on insurance is. We have several such sessions on various facets of insurance. Insurance is an enchanting subject, and no matter whether you are a student, a beginner, an insurance professional, an intermediary, a customer, or whatever, you would find it interesting. Happy learning.